Hello and welcome to Weekend Investing Daily Bytes. Today is 17th of March. We are shooting episode 197 and we have a long weekend ahead of us for celebration of Holi, and the markets have given us a great 4-day run ahead of this festive season and colored the markets green. I wanted to also make this announcement that we have already opened all our popular strategies, MI25, all cap, ATH and ATH2 for limited slots to last through the weekend. And more details about these strategies, of course, you can go and see the hub. The description is there in the link below. As we have been contemplating, the real estate sector seems to be catching a good bid based on many reports that the pricing power is coming back to the sector, and many real estate stocks were leading the rally today, just like yesterday, and just this week real estate is up 5.3%. Autos also have been doing very well, plus 2.2%. Energy stocks, metal stocks, banks, pretty much across the board post this overhang of the Fed hike of interest rate that happened last evening at 0.25%. It seems that the dead weight has been lifted from the various markets. Hong Kong tech stocks have rallied like nobody's business, 30, 40, 50% up on individual stocks when the Chinese government has assured market support. So suddenly there seems to be a lot of good news. Although on the war front, it is still mixed, wherein murmurs from the Russian side are still looking like that things are not yet over, and oil is again catching a bid, almost up 4 to 5% today. So while this has been a fantastic run from on the Nifty from almost 16,000 odd to 17,000 plus, but it remains to be seen whether this will last or not. It has been a ferocious rally, and dead cut bounces tend to be ferocious, but this has also crossed the 200 DMA and the FII buying has also begun. So all the factors seem to be in line for more upside ahead, unless there is some fresh negative news that rolls in. So I think we should remain positive about this until we are faced with some other reality as it comes along. So Nifty, as I said, was up 2%, and all the sub-segments of the market, whether it is CNX 200, 500, mid caps, even small caps, all were up between 1.1 to 1.8%. Most of the MI small cases were also up between 1% and 2%. MI ATH2 was hit due to one stock, and the current gains in the last 1 week have mostly recovered from the recent falls. And for the financial year, of course, MILT CNX2 has underperformed here at plus 7.5%. But I'm very happy with MI All Cap plus 64%, happy with MI25 at plus 58.9%, very happy with EverGreen at 37.3%, MI20, MI35, NNF10, all these strategies have outperformed. MI30 has been all right. MI50 again a good performance, plus 40. ATH is again a decent performance at plus 34. ATH2 since its launch has not done so well, but we are very hopeful that this will recover soon as well. In terms of individual stock movers in the top 500 universe, Angel 1 was galloping at plus 14%, IFB Industries, KI Industries 12 to 13%, Brigade, as I said, in real estate sector plus 10%, and Greaves Cotton at plus 9%. Even on a day like today, there were several casualties. So future retail down 9%, future consumer down 8%. Oil India down 6%. I think we hold this in one of the portfolios. BSC also we hold minus 4.5%. Max Healthcare down minus 4.5%. So today I wanted to, amongst other insights, wanted to revisit our popular strategies because they have been opened up for new subscriptions for limited slots. So it is mandatory for me to explain more about what are these strategies. So MI All Cap is our most subscribed small case. It is as the name suggests, the stocks are chosen from large caps, mid caps and small caps. This is the current composition, 30, 15 and 40. Does not remain fixed, but roughly one third is what is usually nearly is the case. The stocks are chosen based on liquidity and momentum criteria, and it has done really well in this last financial year, current financial year, which is ending in 2 weeks. It's currently up at 62%, versus if we compare it to CNX 500, it is 62% versus 17%. So huge outperformance. And also in the last many years since inception since 2016, it has accumulated a CAGR of 42.9% versus 14.5. So you can see that while this has been an exceptional year, it has been outperforming the underlying benchmark from day one, and it continues to do so. So this is one very, very popular strategy. I think we have the most subscriptions on this strategy, and this has been closed for a long time, and we are opening it up for a few slots right now. MI ATH is another very popular strategy. It shot to a lot of fame post its launch. Once it hit 180% return in 1 year in FY21. Of late it has had some drawdown, but we are very, very confident about this strategy. These strategy, MI ATH and MI ATH2 are very specialized strategies which chase all-time high stocks. So they can be volatile, but once the market does get into that rhythm of a better part of the market doing very well, then they are able to churn out the numbers extremely fast, and they're very concentrated. Both are 10 stocks each, so extremely concentrated strategies, and these should not be your core strategy. This should be a satellite strategy to add alpha in times of need. Right now the distribution here is large caps and mid caps mostly, and very small number of small caps. This has also had a CAGR of 49.3% on the model portfolio since the inception. MI25 is another, in fact this is one of the oldest small cases. This was existing even before small case started, so we started this along with MI50 in 2016, and this has done really well. I mean, it has beaten all my expectations also. Even right now there is no drawdown. I mean, it's sitting at a new high, and it has had a CAGR of 39% almost versus 14% on small caps only, and it is up 56.93%. That was till yesterday and today, so it would have gone up more today for the financial year versus the benchmark here. So it's phenomenal strategy. Goes to cash in times of distress, and chooses to invest only in very liquid small cap names. We did a recent poll to end the week regarding housing loans, just an insight into how people react to real life situations like this. So the idea was that let's say you bought a house worth 1 crore and you had some old property that you sold for 50 lakhs, and you're also eligible for 50 lakhs of loan at 6.8%, the current roughly rate of interest, and you also are holding a portfolio of 50 lakhs, and your current income from your other sources or your job or your business is sufficient to pay for this interest going forward. Let's say you got a loan for 20 years and you were paying this interest. So what would you prefer to do? Will you not take on any debt and sell off your equity portfolio and buy this house cash down, or would you take a 50 lakhs loan and let your portfolio run, or would you sell part of the stocks and bring it down to 25 lakhs or something like that, or others, and a lot of people have given their suggestions, even suggestions like, we should not put up even the 50 lakhs from the old property and put that also into stocks, and pay some long-term capital gains on the real estate, and you'll get better returns. So what has been the experience of the last many decades is that mid-teen returns on equity is not out of the realm of things. A slightly slower portfolio may earn you 10 to 12%. An average portfolio may earn you maybe 13 to 15%, and an excellent portfolio may earn you, let's say, 20% around or something like that. So there is no reason to believe that these kind of statistics will not repeat over the next 10, 15, 20 years. I mean, India is a growth market, and we have tremendous potential to lift people out of lower income to middle income, and middle income to higher income. So still no reason to disbelieve that this outperformance can continue. In other mature markets where we have seen markets not moving for 10 years, 15 years, it's a different case. But in our markets, that is not the case. So if you are able to get a loan of 6.8% and you have the visibility of your own earnings, where you can comfortably pay off that loan gradually at 6.8% or as per the interest rate how it moves, you should be able to make much more than 6.8% in the markets. But of course, the key questions here are your age, the visibility of your earnings, and your comfort level in holding equity, large equity portfolios. A lot of people are not comfortable holding a large chunk into equities, or having this sword of interest on their heads. And that is fine, that if you want to pay down and pay cash, that is also okay. But I think that, and I'm also personally in the same boat where I have taken on a loan and I'm holding my portfolio because I think I should be able to make more than that. The question then remains is it a wise economic decision? So one, of course, is whether buying a house itself is a bad economic decision, and from economics perspective it does seem to be that, and we are buying houses more because of emotional reasons and some peace of mind. But after having made that supposedly economic bad decision, can we sort of not make another economic bad decision by putting all our liquidity into the loan when we are almost getting loans at par with inflation rates right now? So actually the real interest that you are actually paying is virtually nil as of now. And yes, it may go up 0.5%, 1% more in the next 1 year or so, but still I think it remains a very attractive decision to let your stocks outperform over a period of time. Yes, there may be years in the stock market where you may get negative returns, or you may not be able to beat even the bank, but then over a period of time, as we have seen, that we are able to generate a average CAGR much above it. So if you keep the faith, if you keep on gradually investing in the markets, you should be able to do this. So with these words, I want to close today's session. So I want to wish you a very, very happy Holi. Please play safely and enjoy the festival. We have a long weekend. Don't worry about the international markets. We'll take care of them once we are back on Monday. So thank you so much, and see you in another video soon. Bye.